Quantitative Easing and Proposals for Reform of Monetary Policy Operations by Scott Fullwiler and L. Randall Wray. Section 1. Mission and Dual Mandate of the Fed. The Federal Reserve Bank was founded in an Act of Congress in 1913 with its primary directive to furnish an elastic currency. Its mission was expanded in the aftermath of the Great Depression to include responsibility for operating monetary policy in a manner to help stabilize the economy. After World War II, Congress directed the Fed to pursue a dual mandate, long interpreted to mean full employment and reasonable price stability. The Fed has been left to decide how to implement policy to achieve these objectives, and has over time experimented with a variety of methods including interest rates, reserves, and money aggregate targets. While some central banks have adopted explicit inflation targets, the Fed has argued that this would reduce its ability to respond in a flexible manner to disruptions and would not be consistent with its dual mandate. Note also that none of the subsequent amendments to the original 1913 Act have supplanted the Fed's directive to act as lender of last resort or manager of the national payment system in providing an elastic currency. Finally, the Fed has always been responsible for regulating and supervising member banks, a responsibility it shares with Treasury. When the global financial crisis began in 2007, the Fed reacted by providing liquidity through its discount window and open market operations, later supplemented by a number of extraordinary facilities created to provide reserves as well as guarantees. The creation of various standing facilities that provided short-term credit to banks, primary dealers, and others in money markets was labeled credit easing by Chairman Bernanke and others. Most of the credit provided by these facilities had been wound down by late 2009. The Treasury also intervened to provide funds and guarantees to the financial and non-financial sector, in some cases working with the Fed. Some estimates place the total amount of government loans, purchases, spending, and guarantees provided during the crisis at more than $20 trillion, much greater than the value of the total annual production of the nation. Only a very small portion of this was explicitly approved by Congress, and much of the details surrounding commitments made, especially those made by the Fed, is still unknown. While it is beyond the scope of this paper, it has become clear that inadequate regulation and supervision of financial institutions by the Fed played an important contributing role in the transformation of the financial sector that made this crisis possible. A dangerous philosophy developed over the past several decades that deregulation and self-supervision would increase market efficiency and would allocate risk to those best able to bear it. Time after time, the Fed refused to intervene to quell speculative bubbles, on the argument that the market must always be correct. This was made even worse by the Fed's cultivation of a belief that no matter what goes wrong, the Fed will never allow a too-big-to-fail institution to suffer from excessively risky practice. If anything, this encouraged more risk-taking. In recent years, the Fed chose to ignore growth of systemic risk as it directed most of its attention to managing inflation expectations. Unfortunately, it also put much more weight on the inflation outcome while downplaying its other mandate to pursue full employment. This was justified erroneously, we believe, on the argument that low inflation and low inflation expectations somehow automatically lead to robust economic growth and high employment. In summary, the Fed's growing focus on inflation fighting seems to have diverted its attention away from its responsibility to regulate and supervise the financial sector, and its mandate to keep unemployment low. Its shift of priorities contributed to creation of those conditions that led to this crisis. It is likely that this shift of priorities to managing inflation expectations also prevented Fed researchers from recognizing the growth of speculative and risky practices. While inflation over the past 2 decades remaining at moderate level, with inflation over the past 2 decades remaining at moderate levels, the Fed believed its policies were working well. Each time there was a crisis, the Fed intervened to minimize disruptions. Markets coined a term, the Greenspan put, and elevated the Fed chairman to maestro status. While many economists outside the Fed did see it coming, and while they continually questioned the wisdom of allowing serial speculative bubbles in equity markets, real estate markets, and commodity markets, Fed researchers and policymakers mostly dismissed these warnings. Markets also frequently recognized the risks, but presumed that the Fed would bail them out of crisis. When policymakers view their role as one of ignoring systemic risk while promising rescue, they are effectively serving as cheerleaders for bubbles, manias, and crashes. This was a dangerous mix, bound to result in catastrophe. In conclusion, the current crisis demonstrates the wisdom of returning the Fed to its original mission, as amended over the years by Congress. 1. Provision of an elastic supply of currency, acting as lender of last resort to banks when necessary to quell a liquidity crisis. 2. Regulation and close supervision of financial institutions to ensure safety and soundness of the financial system. This responsibility would include use of margin requirements and other means to prevent financial institutions from fueling speculative bubbles. It also means resolving insolvent institutions rather than adopting a policy of too big to fail that promotes and rewards reckless behavior. And 3. Pursuit of the dual mandates: full employment and reasonable price stability.